Mapletree Pan-Asia Commercial Trust, once one of the most stable REITs in Singapore, is now trading at nearly 50% below its all-time high. What went wrong, and is this a rare opportunity or a value trap? In today's video, we're diving deep into MPACT, its massive share price plunge, the real story behind its portfolio performance, and whether this REIT can bounce back in a rising interest rate world. We'll also look at business overview, key financials, and our own final verdict. If you're a dividend investor or REIT hunter, stay tuned. You won't want to miss this. Since its 2020 peak, Mapletree Pan-Asia Commercial Trust's share price has plunged nearly 50%. And here's why. First, interest rates have surged. Mapletree Pan-Asia Commercial Trust's all-in debt cost jumped from 2.4% to over 3.3%. Eating into distributable income and lowering DPU. Second, weak leasing demand hit key markets. Japan occupancy plunged below 80%, and rental reversions in China and Hong Kong turned negative, dragging revenue. Third, asset values fell. Amid 2024 revaluation saw Japan properties drop 17%, with the Fujitsu Makuhari building alone losing 40% after its main tenant announced a 2026 exit. Fourth, currency headwinds hurt. A stronger Singapore dollar reduced overseas earnings when converted back to SGD. Finally, divestments like Mapletree Anson cut short-term income, even though proceeds were used to pay down debt. In short, rising costs, weak demand, falling valuations, FX risks, and asset sales all combined to shake investor confidence and send Mapletree Pan-Asia Commercial Trust tumbling. Mapletree Pan-Asia Commercial Trust, or MPACT, is Singapore's premier Pan-Asia commercial REIT, listed on the SGX since April 2011 and rebranded in August 2022 after merging with Mapletree North Asia Commercial Trust. As of mid-2025, MPACT holds a portfolio of 17 commercial properties across 5 key Asian gateway markets: Singapore 4 properties, Hong Kong 1 properties, China 2 properties, Japan 9 properties, and South Korea 1 property. These collectively span about 10.5 million square feet of lettable area, with assets valued at around 16.0 billion Singapore dollars. Singapore remains Mapletree Pan-Asia Commercial Trust's core market, representing over 57% of AUM and around 61% of net property income post-divestment of non-core Japan assets. As at June 30, 2025, the portfolio maintains a committed occupancy rate of 89.3%, with WALE, weighted average lease expiry, of approximately 2.3 years, 2.2 years in retail, and 2.4 years in office/business parks, underpinning income visibility. The manager's goal is clear: to deliver stable, long-term distributions and NAV growth, driven by a diversified portfolio anchored in Asia's gateway cities. It emphasizes proactive capital management, income stability, and strategic asset optimization, such as recent investments to reduce debt and concentration risk. Here's a visual breakdown of Mapletree Pan-Asia Commercial Trust portfolio as of mid-2025, starting with its business segments. About 60% of MPACT's gross rental income comes from office and business park properties, including core office assets in Singapore and Tokyo, as well as the business park cluster adjacent to Vivo City. The remaining 40% is driven by retail properties, anchored by flagship malls, such as Vivo City in Singapore, Festival Walk in Hong Kong, and prime retail assets in China. This reflects a strong bias towards commercial workspace, while still maintaining meaningful exposure to regional retail. Geographically, MPACT remains anchored in Singapore, which contributes approximately 56% of its total assets and net property income. Hong Kong SAR, home to Festival Walk, contributes another 26%. The rest is diversified across Japan 8%, China 7%, and South Korea 4% through strategic holdings in key business districts. This Asia-focused footprint provides MPACT with stable income from mature markets, while spreading risk across multiple economies. Let's begin with MPACT's home ground, Singapore, which makes up the largest portion of its portfolio at around 9 billion Singapore dollars. The crown jewel here is Vivo City, valued at approximately 3.1 billion Singapore dollars, followed by Mapletree Business City at 2.8 billion Singapore dollars. M Tower and Bank of America Harborfront round out the core assets, with estimated values of $1 and 60 cents billion and 1.5 billion Singapore dollars, respectively. Together, these four commercial assets form a resilient income base in one of Asia's most stable markets. Next, we move to Hong Kong SAR, where Festival Walk is MPACT's flagship overseas asset. This iconic retail and office development is valued at around 4.2 billion Singapore dollars, making up roughly 26% of the trust's total portfolio. Despite market volatility, Festival Walk remains a key contributor to MPACT's rental income. In Japan, MPACT holds a diversified set of 9 commercial properties, collectively worth about 1.1 billion Singapore dollars. The bulk of the value lies in the Tokyo assets at 0.6 billion Singapore dollars, followed by Yokohama at 0.3 billion Singapore dollars, and Chiba at 0.2 billion Singapore dollars. These offices provide stable income from established business districts. Over in China, MPACT owns 2 major assets, Gateway Plaza in Beijing and Sandhill Plaza in Shanghai. Gateway Plaza contributes about 550 million Singapore dollars, while Sandhill Plaza adds another 450 million Singapore dollars, bringing China's total to around 1 billion Singapore dollars. These assets anchor MPACT's retail and office presence in 2 of China's top-tier cities. Finally, in South Korea, MPACT holds a 50% stake in the Pinnacle Gangnam, one of Seoul's Grade A office towers. This single asset is valued at approximately 600 million Singapore dollars, contributing around 4% to the overall portfolio. It reflects the trust's selective expansion into high-quality commercial hubs across Asia. Altogether, MPACT's diversified property base, from Singapore to Seoul, offers both income stability and regional exposure. This strategic spread not only balances risk, but positions the REIT to capture long-term value across Asia's top gateway cities. In Singapore, MPACT holds approximately 18% of the REIT market, behind CapitaLand Integrated Commercial Trust, CICT, with 25%. Keppel REIT and Lendlease Global REIT hold 15% and 8% respectively, while other REITs make up the remaining 34%. MPACT's key assets like Vivo City and Mapletree Business City contribute significantly to this strong local presence. In Hong Kong, MPACT commands around 26% of the market, thanks to its iconic Festival Walk asset. Link REIT leads with 30%, while Sunlight REIT and Champion REIT hold 15% and 10% respectively. The rest of the market is split among smaller players. In Japan, MPACT is smaller, holding about 8% of the market. Japan Real Estate Investment Trust leads with 28%, followed by Nippon Building Fund at 25% and Mitsui Fudosan REIT at 20%. Despite its smaller share, MPACT's 9 office buildings provide stable rental income in key cities like Tokyo and Yokohama. In China, MPACT holds roughly 7% of the REIT market, mainly through Gateway Plaza in Beijing and Sandhill Plaza in Shanghai. Competitors include BHG Retail REIT at 22%, Sasser REIT at 20%, and EC World REIT at 15%. The remaining 36% is split among other REITs. In South Korea, MPACT holds a modest 4% share through its 50% stake in the Pinnacle Gangnam. Myri Asset REIT dominates with 30%, followed by Korea Real Estate REIT at 26%, while other REITs collectively make up 40%. These charts highlight how MPACT's presence varies across Asia, from a strong foothold in Singapore and Hong Kong to selective investments in Japan, China, and South Korea, balancing both scale and diversification. Here's a summary of MPACT's latest financial performance, comparing the trailing 12-month figures with FI 2024 and FI 2023. Revenue came in at about 908.8 million Singapore dollars for the TTM, down roughly 5% from 958.1 million Singapore dollars in FI 2024, but still above FI 2023's 826.2 million Singapore dollars. Net income rose slightly to 588.8 million Singapore dollars, marking a modest increase over FI 2024, which saw 582.7 million Singapore dollars. EBITDA jumped to around 802 million Singapore dollars, compared to 679.8 million Singapore dollars in FI 2024, an impressive rise of approximately 18%, reflecting improved operational efficiency. Margins remain healthy, with net profit margin around 64.8%, up from 60.8% in FI 2024. Operating margins are still solid, even if slightly compressed. Free cash flow came in at about 612 million Singapore dollars, down from 725 million Singapore dollars in FI 2024, consistent with a 15% decline, likely due to higher capital outflows or slower collections. Leverage is well managed. Debt-to-equity ratio stands at 0.63, stable and slightly improved from 0.70 in FI 2023. Earnings per unit (EPS) for the TTM is 11 cents, flat compared to FI 2024. The share price likewise has hovered around 1 Singapore dollar and 28 cents, showing no meaningful change year over year. Trading volume remains robust, with average daily turnover of about 8.6 million units, reflecting steady market interest. Here's a 4-year snapshot of Mapletree Pan-Asia Commercial Trust's key financial performance. Starting with gross revenue, MPACT has grown steadily from 1.31 billion Singapore dollars in FI 2021 to 1.59 billion Singapore dollars in FI 2024, marking a compound annual growth driven by portfolio acquisitions and rent escalations. Likewise, net property income rose from 951 million Singapore dollars to 1.15 billion Singapore dollars, maintaining a stable NPI margin of around 72%, reflecting solid operational efficiency. The payout ratio remained disciplined, hovering between 64% and 71%, ensuring MPACT retains capital for reinvestment while rewarding unitholders. Overall, MPACT has delivered sustainable growth and stable income despite market headwinds through proactive asset management and regional diversification. Let's take a closer look at the valuation metrics of Mapletree Pan-Asia Commercial Trust, or MPACT, from 2021 to 2024. Starting with the price-to-book ratio, it declined from around 1.09 in 2021 to just 0.88 in 2023, before slightly recovering to 0.91 in 2024. This suggests that the market has priced MPACT below its net asset value, signaling potential undervaluation. MPACT's net asset value per unit has grown steadily from 2 Singapore dollars and 6 cents in 2021 to 2 Singapore dollars and 13 cents in 2024, reflecting a strengthening balance sheet and asset appreciation. Dividend yields have fluctuated, dropping to a low of 2.5% in 2022 amid market volatility, before rebounding strongly to 5.82% in 2024, offering attractive returns for income-focused investors. The price-to-FFO ratio is currently not disclosed in annual reports, but the available metrics already give a clear picture. MPACT is trading at a discount to book value, while delivering stable and rising distributions, potentially offering both value and yield for long-term investors. Let's take a look at Mapletree Pan-Asia Commercial Trust's income performance over the past 4 years. Starting with funds from operations, or FFO, which represents core cash flow, we see steady growth from 865.6 million Singapore dollars in 2021 up to 931.6 million Singapore dollars in 2023. However, in 2024's trailing 12 months, FFO dipped to 691.5 million Singapore dollars, reflecting headwinds in the macroeconomic environment, such as higher financing costs and weaker rental contributions from certain overseas assets. Next, the interest coverage ratio, which gauges MPACT's ability to service its debt. It declined gradually from 4.1 times in 2021 to 3.6 times in 2023, and further down to around 3.1 times by mid-2024. This trend suggests that interest expense is growing faster than operating profit, a common theme among REITs in a rising rate cycle. Overall, MPACT has shown operational resilience but must navigate elevated borrowing costs and currency volatility across its geographically diverse portfolio. Now, let's look at the operational strength of Mapletree Pan-Asia Commercial Trust, or MPACT, in 2024. In Singapore, MPACT's core assets continue to shine. Vivo City is fully occupied at 100%, while Mapletree Business City and PSA Building maintain above 98% occupancy, reflecting strong leasing demand in both retail and business park segments. Office properties like M Tower and Bank of America Harborfront also perform solidly, with occupancy above 96%. Overseas, Festival Walk in Hong Kong remains a cornerstone asset with an impressive 99.8% occupancy, even amid macro headwinds. In China, Gateway Plaza and Sandhill Plaza show resilient demand with rates above 93%. In Japan and South Korea, high-quality commercial towers like JP Tower Nagoya and Pinnacle Gangnam are nearly full. Meanwhile, the Mitsubishi Front Tower in Osaka and Al Ghurair Tower in Dubai are fully leased, hitting 100% occupancy. Overall, MPACT's broad portfolio across key gateway cities demonstrates strong operational stability and diversified income streams. Here's a breakdown of MPACT's lease expiry profile, or WALE, across its key property segments. The retail portfolio has a WALE of 2.2 years, reflecting the shorter, dynamic leasing nature of retail tenants. Meanwhile, the office portfolio shows a stronger lease tenure with a WALE of 3.5 years, providing more predictable rental income. As for integrated developments, which blend office, retail, and lifestyle spaces, the WALE stands at approximately 2.6 years, offering a balance between flexibility and income stability. Overall, this diversified lease structure provides MPACT with both resilience and agility in navigating market cycles. Let's take a closer look at Mapletree Pan Asia Commercial Trust debt and leverage profile over the past few years. Starting with the gearing ratio, we see a steady increase from 34.2% in 2021 to nearly 40% by 2024. This remains well within the MAS regulatory limit of 50%, giving MPACT some financial headroom. Next, the cost of debt has risen from a low 2.3% in 2021 to 3.5% as of mid-2024, reflecting the broader interest rate environment. Despite this, the REIT continues to manage borrowing costs prudently. Fixed versus floating interest exposure is another important indicator of risk. MPACT has consistently hedged a high percentage of its borrowings, with 76 to 78% of its debt fixed, which buffers against rate volatility. Finally, looking at the debt maturity profile, the average term stood at 3.9 years at the end of 2023. By mid-2024, only about 13 to 15% of total debt is due in the 2025 to 2026 period, with the rest long-dated, suggesting limited near-term refinancing risk. Overall, MPACT's leverage strategy remains conservative and well-balanced, safeguarding its distribution stability amid rising rates. Mapletree Pan Asia Commercial Trust, or MPACT, presents a balanced investment story of opportunity and caution. On the upside, the REIT stands to benefit from post-pandemic recovery in office and retail leasing. With a geographically diverse portfolio across Asia-Pacific and a strong tenant base, MPACT is well-positioned to generate resilient income. Enhancement works and assets located in prime, transport-linked locations offer potential upside. Moreover, investors seeking stability in turbulent times may find MPACT's REIT structure and distributions attractive. However, risks remain. Rising interest rates can drive up financing costs, and currency volatility from overseas markets could affect returns. Shorter WALEs in retail may lead to income volatility, while increased competition and regulatory caps on gearing could limit expansion. Ultimately, prudent management and focused capital deployment will be key to navigating these headwinds. Mapletree Pan Asia Commercial Trust offers exposure to prime retail and office assets across Asia, backed by the strong Mapletree brand. Despite rising interest rates and currency risks, MPACT maintains strong occupancy, stable gearing, and positive rental reversions. Its diversified tenant base and well-managed debt profile make a resilient long-term play. If you're seeking steady income with regional diversification, MPACT remains a compelling REIT pick. Comment your thoughts and subscribe to Durian Finance.